into an analysis report on DJT stock. It's looking at that recent, pretty massive 8.28% spike.
Mm-hmm.
And it attributes the whole move to this strategic pivot into nuclear fusion and AI energy infrastructure.
A huge pivot.
It is. And right off the bat, the high energy, very contrarian approach, it's effective. It grabs you, and it clearly lays out this golden opportunity thesis, based on the stock's climb from around $10 to over $16.
It's a strong hook, for sure. The title alone, DJT explodes, plus 8%. Why this dip was a golden buying opportunity? It pulls you in.
It does. But that conviction, while it feels strong, it needs some serious structural support to really turn this from, let's say, compelling speculation into an ironclad case.
I agree, the foundation is there, but when you make a high-conviction call like this, you need equally high-quality evidence to back it up.
Exactly. So let's start with the engine of the whole thing. The report makes a very strong case that the surge was all about the reported $6 billion merger with TAE Technologies.
The pivot.
The pivot, yeah, from social media to this nuclear fusion and AI energy play.
And that's the big exciting idea. The thing is, the link that's established between that explosive price move and the massive business pivot, it just needs deeper analytical support to move beyond correlation and really prove causation.
That's the critical step, isn't it? Moving from just reporting the news to actually analyzing the market-specific reaction to it.
It is. So the weakness here is that the report asserts the market is pricing in this huge long-term industry shift. It positions that dip to $10 as the golden opportunity for smart money to get in.
Okay.
But the analysis doesn't give us any concrete, specific evidence like, say, regulatory filings or market reports to prove that the TAE news was the direct catalyst.
Rather than just what? A technical bounce.
Exactly. Rather than just heavy short covering that happened to occur at the same time. I mean, if the market was already coiled for a technical bounce, the news might have just coincided with it, not caused it.
I understand the skepticism. It's so hard to isolate one single cause in a stock this volatile, this heavily watched. So the suggestion then is, how do we prove it wasn't just noise?
You have to lock down the timeline and follow the money-specific footprint. Fortify that causal argument by integrating specific data points. Show when the TA news became the dominant story or was officially signaled.
And link it directly to the volume.
Link it directly to that volume uptick that led to the gap up from Thursday's close of $14.86. If this is a true fundamental pivot, that timeline has to line up perfectly.
That makes it really actionable. Can you give me a couple of concrete examples of how you could trace that fingerprint?
Sure. First, you'd cite the exact date or even the timing of the key filing or announcement that officially communicated the pivot.
The press release, the SEC filing, whatever it was.
Unprecedented volume came in after that official communication. The case for causation is, way stronger.
And if the volume spike started before the news broke?
Then it was likely something else. A technical setup, a rumor, short covering. Something else was driving the bus.
Okay, that covers the timing. But what about the quality of the money coming in? The report leans so heavily on this idea that smart money saw the opportunity.
And that's where you need more advanced metrics. Instead of just stating that smart money saw the cash pile, you need to illustrate what specific metrics would tangibly show that.
So what does that look like?
For instance, you could track a change in institutional ownership percentages leading into or right after the news. Or even better, examine the options activity.
Ah, the options market.
Yeah, you look for massive spikes in call volume versus put volume. A huge call-put volume spike is like a high-fidelity fingerprint for where big, leveraged money is placing its bets. It tells you institutions are betting on a rise.
That's so much more rigorous than just looking at the day's total volume. You're moving from just observing the fire to showing the reader who actually struck the match.
Exactly. It validates the report's own high-conviction narrative by swapping out an assertion for verifiable institutional data.
Okay. So once we've established that primary cause, we need to look at how it's presented alongside the other ideas in the report.
Yes. And that brings us to the next big point.
Which is that the material tries to present this holistic, everything Trump holding company view. It brings up both the Fusion AI pivot and this crypto angle from the Crypto.com partnership.
Right. And the introduction of these multiple highly divergent investment angles, fusion infrastructure and crypto, it just dilutes the clarity and the focus of the main value proposition.
It gets muddy.
Very. If the first critique was about proving what happened, this one is about simplifying why an investor should care. And right now that why is confused because it's trying to be everyone to everyone.
I do wonder, though, if maybe the intent is to address that retail investor base who might be drawn in by the brand and these big, flashy partnerships like Crypto.com. Wouldn't dropping that angle kind of undermine the whole everything Trump concept?
That's a valid point on strategy, but that's also where the analytical weakness lies. The report just shifts gears so quickly. It goes from detailing this massive long-term industry shift,
The $6 billion fusion merger.
right, which appeals to deep tech and infrastructure investors, and then it just pivots to a brand partnership in a completely different world.
Which appeals to digital asset and brand loyalty retail folks.
Totally different audiences. These two theses have vastly different risk profiles, different time horizons. It's confusing.
It almost sounds like the analytical equivalent of trying to drive a car with one foot on the gas and one on the brake. You don't really go anywhere fast.
That's a great way to put it. The reader walks away not knowing if they should value this as a speculative tech utility or as a meme stock brand play.
And they end up not really making a strong case for either.
Precisely, if you try to speak to two different fundamentally opposed investor segments, you often end up speaking persuasively to neither of them. So, the suggestion for improvement is to structure the report to either go all in on the strongest narrative,
The fusion AI pivot.
the monumental fusion AI pivot, yes, or to clearly differentiate between the short-term catalyst and the long-term fundamental shifts. You just need some analytical discipline, some decisiveness.
So if the choice is clarity, what's the best path forward?
Well, if the fusion play is the main future-defining driver, then you should probably drop the crypto angle section entirely, or, relegate it to a single high-level sentence about minor diversification.
Keep the focus laser sharp.
Exactly. Ensure that 90% of the word count stays on the $6 billion merger thesis and this radical shift into energy infrastructure. That elevates the report. It becomes a serious institutional analysis of a strategic pivot.
And what if they're determined to stick with the holding company model, if that's the core idea?
Then you have to do the work. If the everything Trump holding company model is the intended thesis, you must dedicate a real substantive section to explaining the potential for synergy.
How do these completely separate things, media, crypto, energy, actually create value together?
Yes. Or if synergy is impossible, which it might be, then how does this diversification mitigate some specific conglomerate risk? Just presenting them as disconnected pivots is like throwing two unrelated darts at a wall. You have to show how they form a cohesive constellation.
Okay, so that gives two very rigorous paths forward. We've established the cause, we've refined the thesis. Let's move on to the technicals, which really need to justify those aggressive price targets.
Excellent. Yeah, the technical side is where that conviction needs to be translated into quantitative probability.
So the analysis does provide clear, actionable key levels for Monday. It identifies $14.80 to $15 as support and $17.10 as that critical resistance level, which it says leads to a $20 psychological magnet. The levels themselves are sharp, they're actionable, that's a strength.
It is a strength. But the technical section needs to integrate broader market context and deeper quantitative metrics. It needs more than simple support and resistance lines to truly support that high conviction tone.
I can see the gap. The whole thesis is built on this massive reversal that's trapping the shorts, but the evidence offered is pretty much just price action from the last 24 hours.
Right.
And that aggressive forecast that $20 is probable, it feels a little unsupported when it's based on only 3 price levels.
Exactly. If you're going to call the shorts trapped, you need to show the technical pressure that's actually driving them out. So the suggestion is to incorporate elements of volatility, broader volume analysis, and critically, short interest data.
Short interest.
You need to provide quantitative evidence that justifies that aggressive upside forecast and demonstrates the forced weakness of the shorts.
We need technical proof that a move past $17.10 isn't just a breakout, but that it will trigger a violent, forced rally. So how can we do that concretely?
3 ways. First, you have to quantify the demand. Reference Friday's volume, the volume that drove that huge gap up, but compare it to a longer-term benchmark, like the 50-day or 90-day average volume.
So instead of just saying immense demand, you say volume was 300% of the 50-day average.
Precisely. It moves the claim from a subjective statement to an objective fact. And choosing that 50 or 90-day average helps establish if this demand is truly unprecedented against recent history or if it's just a minor uptick.
Okay, that instantly contextualizes the energy of the move. What about that trapped shorts claim?
That's the crucial missing ingredient. You have to integrate a metric like the percentage of the float that is currently shorted.
The float being the total shares available for trading.
Yes, and you explain that a high percentage of that float is shorted. Then you explicitly explain how a move past your $17.10 resistance level would trigger a cascading short squeeze. That provides a technical mechanism that makes the $20 target analytically probable, not just aspirational.
So we're creating a direct technical link. $17.10 isn't just a line on a chart. It's the trigger point for a massive pre-quantified short squeeze.
You got it. And then finally, contextualize the $10 low. It's labeled the golden opportunity low, but we need to establish its real significance.
Where did it come from?
Exactly. Note how far that drop was from previous longer-term resistance points. Did it retrace 50% from the last month's peak? 70%? This establishes a proper multi-week floor that really underscores the significance of the current $14.80 to $15.
So without that historical context, the $15 floor is just a number. With context, it proves the stock actually established a key reversal point.
That's it. By integrating these elements, we're transforming a high-energy, kind of high-risk analysis into something that's technically robust, something that appeals to institutional and advanced retail traders.
We're moving the entire report from high-energy speculation to evidence-based analysis.
Proving the cause, clarifying the value, and justifying the target.